Okay, welcome everybody to our tax time end of financial year webinar. For those of you who don't know me, I'm Patrick Connolly. I'm one of the senior consulting accountants here. Me is Gareth Stead, another one of our accountants. So Quantum Advisory, for those of you who don't know us, we're an advisory firm based in Windsor and Wollongong. And our mission is to help family businesses to gain control, grow profits and reduce tax. So we're on the reduced tax side of it today. We've got a webinar planned out for you with a few sections. First, we're going to go through all the actions that are available to be taken before 30 June, so the things you need to know of before the end of the financial year. Then we're going to look at balance sheet review items that we can do to help us save tax. Then we'll have a look at FBT and motor vehicles in particular. And then finally, to wrap up, we've got some comments specifically around things that are appropriate for trusts or companies specifically, as well as some time for questions at the end. So we do have a Q&A box. Feel free to throw in the questions at any time when we get to the end. We'll go through those and try and answer as many as we can. We hope sort of this will go for half an hour, 40 minutes kind of time frame. So we'll try and move through it pretty quickly. All right, let's get going.
Yeah, so first up is instant asset write-off. So most people probably would have heard about this. So most of our clients would be eligible now, given the fact that it's a $5 billion turnover threshold.
Most of our clients are, yeah.
Yeah, so for second-hand assets, this is only available for business with turnover under $50 million. Since 6th of October, we've been able to write off any asset of any value. So prior to that, it was only up to a certain limit. However, with the temporary full expensing, it does exclude some assets such as buildings, primary production assets, and things like software and development costs.
In-house software. So I think overall, the point we're making here is that at the moment it's pretty broad. If your turnover is under $5 million and you're buying a new asset, any new asset you purchase between now and 30 June, any value, you'll be able to get a tax deduction for the full purchase price in this current financial year. So we tried to weave in some examples here. So I'll run through this one. So we've got a manufacturing business. And we decide before the end of the financial year, we're going to buy 100 grand's worth of equipment. The new machines, they should speed up our production. They give us more capability. And we think that's going to generate an extra 200 grand GP next financial year. So first, we want to always look at the ROI and make sure we're not spending money just for saving tax. So we do know that it's going to generate 200 grand gross profit. Should pay itself off in the first year we have it. So we go ahead and we buy it before 30 June. Because it's a company, its tax rate is 26%, so it gets a tax deduction of $100,000, which is worth saving $26,000 in tax that otherwise would have been paid for that financial year.
So the next one is superannuation. So superannuation, the important thing to note with superannuation is that it's only tax deductible when it's paid, not when it's actually incurred. So for example, any wages paid during the June quarter, the super is not actually due until the following financial year. However, that expense is not deductible in this financial year unless you pay it.
I've also put the point there that there's some fairly harsh penalties when super is paid late that do affect your tax as well. So I'll just run through those and try and get you in a number of different ways. So first of all, any super that's not paid by the due date, it's not tax deductible at all. You never get a tax deduction for it. Also, when you pay super late, even if it's a day late, doesn't matter if it's a day or a year late, when you pay it late, you have to lodge what's called a superannuation guaranteed charge statement, which generally means you're paying your accountant to do that. That statement lists all the employees per quarter that have a late payment or no payment. You are required to pay a $20 admin fee per each employee per quarter. You're also required to pay interest on the amount that's due from the day that it was due, not till the day it was paid, but till the day you lodged the statement. So if you overlook the fact that it was one day late and you lodge a statement a year later for an audit, you're going to pay interest on a year's worth of that. Also, if it's late and you're lodging an SGC statement, super is actually payable on your overall wage bill rather than just the items that normally track super. So things like car allowances, overtime, any other allowances that aren't ordinary time earnings, normally you don't pay super on those amounts. But if you're paying it late, you're actually going to have super calculated on everything you paid, not just those items that normally attract super. So they really do get you 3 or 4 ways. It really is really important just to try and pay that on time.
Yeah, it's important to note too that sometimes when you process super payments, they can take a few days to actually reach the fund. So it's important to make sure you pay it a few days before the due date so that it reaches the fund before it's due. So even if you paid it 1 day before and it didn't get to the fund until after, that's still considered late.
Yeah, so one thing we might say, with a lot of clients would look at this in the June quarter in particular, try and get that paid early. If you can calculate the super for the whole quarter and pay it early, that's great. But like Gareth said, you want to give yourself probably at least a week to make sure that payment hits. What a lot of people end up doing is if they've got fortnightly or month or weekly payroll, they'll pay the super for every pay run except maybe the last pay run. So they get most of it in their deductible without having that worry. So a worked example here, if you've got $20,000 of super that's accrued in the June quarter, you normally pay it by the 28th of the month following the quarter, being July. If instead you got your act together and paid it in June, the whole lot then becomes a tax deduction in the current year. If you're a company with a tax rate of 26% and you had 20 grand of super accrued, you'd save 5,200. For a lot of people, their super for a quarter is a lot more than 20,000, so you can imagine the savings a lot more than 5,200 as well.
Yeah, so next up is additional super contributions. So contributions to super are tax deductible up to a limit of $25,000 per year per person. So that includes any super paid through employee contributions.
Yeah, so I guess what we're saying here is to look at, this is more looking at key people in the business and family members, essentially, that you're obviously paying super through payroll, but you could top that up to $25,000 and get a big tax saving. If your marginal rate on your own earnings, if you're a high income earner and you're paying a top marginal tax rate of 47%, for example, you get a tax deduction of 47%, pay your own super fund and only pay tax at 15%, and you've pocketed the difference that you would have otherwise given to the ATO, is now sitting in your super fund instead. One line I've got there is just to watch out for the Division 293 tax. So the ATO doesn't like people being able to do that too much. They want people to be self-sufficient, but only to an extent, apparently. So the idea here is that if you've got an income over $250,000, they'll actually tax you an extra 15% on those super contributions. So you're paying 30% instead of 15, which, still a saving because if you're earning that high income, then you're obviously paying the top marginal rate, but you don't get the full saving that everyone would get.
Yeah, so in this particular example, Barry has a taxable income of 180, so he's already at the top tax rate. He takes a wage and gets $12,000 in employer contributions. So that means he can make an additional contribution of $13,000. Obviously, the 25 plus the 12, the 12 plus the 13 gives 25. So basically, that results in a net tax saving of $4,150.
That's the difference between the tax he would have paid in his own rate versus the tax he paid in super. Yeah.
Yeah. So another example, in a situation where someone hasn't received a wage, in this example, that person can actually deposit the full $25,000 into super, which results in a net tax saving of $8,000.
This next example is a bit more complicated. So we've got Mr. Smith. He's got a lower income, so he's only paying tax of 34.5%, but he's over 65. He started taking a pension from his super fund, so he doesn't have the surplus cash. He doesn't really have a spare $25,000, but he's interested in saving the tax. So he talks to a licensed financial planner, and I'll emphasize that point, and he works out this will work for him, and he puts $25,000 into super, and then he goes ahead and withdraws $25,000 back out as a pension from his super fund. So he doesn't have any net cash flow. He's put 25 in and pulled 25 out shortly later. But in doing that, he's got a tax deduction of $25,000 he can claim at 34.5%. And he's only paid tax in the fund for putting it in of $3,750. So he's got a net tax saving there of $4,875. And because that pension is tax-free to him because of his specific personal circumstances, he's got a big tax saving there from really no cash impact. So that is an example of how it can work in a perfect world. It's not going to be that clean for everybody because everybody's circumstances are a little bit different. I guess the reason I put it in was just to draw your attention to the fact that it might be available, especially if you've got an SMSF, because it can make it a lot easier as well. But even if you don't, if you are over 60, or even not even over 65, just over 60, still working, talk to us about whether something like this might work for you and whether we can get a much better tax outcome without much of a cash impact.
Yeah, so the next one is prepayments. So for small businesses, prepayments are things like insurance. They can actually be deductible in the year they're paid. So even if they spread over into the next financial year, they can be fully expensed in this year.
If you've got any big insurance bills that you could pay one go in June, you will get a tax deduction for that.
Exactly.
Even though it relates to the next year.
Yeah, and so the other one is employee entitlements. So things like annual leave and long service leave. If you were to pay some of these out at a time of your choosing, rather than waiting till the employee takes it or is terminated, that allows you to claim the deduction in the current year.
Yeah, and so I've got an example here on the next slide. So you've got Tim. He's on a salary of 92,000. He's got 17 weeks of annual leave because he never goes anywhere or does anything. He agrees to cash out 13 weeks of his leave. Actually, he's very happy about cashing out 13 weeks of his leave when he's offered. He gets a payout of 27 grand. The employer, whose tax rate is 26%, gets a tax saving of $7,026. Now, it's a tax saving that's been brought forward for a future period because that liability was always going to be paid. So there's two advantages for the employer. One is we're bringing that tax saving and getting that now. Obviously, we've had to pay out the payout to get it though. The other significant advantage in this is that you've got a liability already. Tim's employer already has a huge liability sitting on the balance sheet. If Tim had pulled up stumps and said, I'm leaving in 6 months' time, and it was completely unexpected, it might come at a time when cash flow was really tight. And all of a sudden you're paying out more than 27,000, you're paying out the full leave at a time when you weren't expecting to, you had no warning, and it's probably not a good time. So if you find yourself at the end of the financial year in a better cash position, interested in a tax deduction and also de-risking the business by paying out a liability early.
Yeah, the other point to make is that annual leave is paid out at the employer's current pay rate at the time of paying it out. So yeah, so if you were to pay it out down the track when maybe you've given them a pay rise, they're getting,
it'll be worth more.
Yeah, exactly.
Yeah, absolutely. That was our wrap up of actions that you can take before 30 June. Things that are important to know that need to be acted on prior to the end of the financial year. Now we're going to go through a few of the balance sheet items and the actions we can take to improve the tax position.
So first up is inventory. So when it comes time to doing your end of year stock take, there's a few ways that you can value your stock, and the ATO gives us the liberty of choosing the lowest option. So the first one is cost. So that is the cost you actually of the inventory, how much you actually paid for it. The other one is replacement value. So how much would each unit cost to replace? And then probably the best one is actually the net realizable value. So what that basically means is how much can I sell it for? So I might have paid $10 for a particular unit. I might only now be able to sell it for $5. I can value that unit at $5.
Yeah. So we've got an example here. So ABC Proprietors Limited. So the full stock take at 30 June. And it comes up from there that it's got $50,000 of stock that it's been holding on to for more than 12 months. And the directors look at that stock, they look at the market, and they feel like, well, they could probably, if they send it to auction, they might get half back of what they paid for it. And then they've got another $20,000 of stock that is just obsolete. They're not going to sell it. Nobody wants it. So they can write off that $20,000 and they can write off half of that $50,000, which gives them a tax deduction of $45,000 in the current year. And they're going to pay $11,700 less tax than they would have otherwise, just from valuing their stock correctly, essentially. Worth noting on this one, though, that it's not a freebie. If they write off that $20,000 of stock this year, because they say it's obsolete and has no value, and then they go ahead and sell it next year, obviously that full amount then is assessable income because there's no cost base for that stock. Also, just one other point on this, when you're doing that stock take, and you're making these decisions, it's good to have a record of what decision you made and how you made it. So that can be something as simple as a stock take sheet. Highlight the item you're talking about, and the director makes the note that it's not worth that. Market value is this, and this is the day you made that decision. Just file that somewhere, just so that you've got a record of the directors having made that call, and so the accounting records are complete. Yep. This is probably a really simple one around debtors. So it's just saying check for bad debts. So run your age debtors listing. You should probably be doing this end of every month or quarter at least anyway, but definitely at 30 June. Run your age debtors listing and sit there and have a look at it for anything that might not be paid. If it's not going to be paid, you don't want to pay tax on it. You want your GST back. You've already been hit, you don't want to pay tax as well. So worked example here. ABC Proprietary Limited conducts a review. Notes there's an invoice of 11 grand that's been dudded on. Directors decide they're going to write it off. They're not going to get paid. Company gets a refund of $1,000 GST it already paid because it was from a prior quarter, and they're not going to pay the income tax of $2,600 on that invoice. So they're making sure they're not paying tax or GST on income they never received.
Yeah. So the next one is fixed assets. So it's very important to review the depreciation schedule at least once a year to make sure that any assets that are obsolete or scrapped are removed essentially, so we can claim the tax deduction for them.
So a lot of assets now, for most small businesses, we're using small business depreciation, which means that we're claiming the instant asset write-off for anything that was under that limit in the past, and anything that was over that limit, which doesn't exist since October but did before that, was going into a general pool, a small business pool. And the way that the pool works is that all those assets, every asset that goes into the pool gets written off at a fast depreciation rate, but it's a standard rate. So you're just adding to the value of the pool, and the pool gets written down each year by a standard rate. But it does mean if you dispose of an asset, you don't get an instant deduction for that. It just reduces the balance of the pool. So pooled assets are going to be treated differently for tax. You probably don't need to get bogged down in the detail of it, and your accountant can tell you if you're using the pool for tax depreciation. But we make the point that even if you're not going to get necessarily a straight up deduction for writing assets off your depreciation schedule, still, again, something you should be looking at regularly, whether that's annually or every 6 months or so, looking at the depreciation schedule, scrapping assets that aren't there or writing them down if the value's not real, because it's still going to impact your financial statements. It's still going to we still want your financial statements to reflect the real value of your assets and the real position of the business, and it can't do that if we're not reviewing the schedule to make sure it's realistic.
Yeah, so in this example, ABC reviews their depreciation schedule, and there are items on the schedule which have actually been disposed of in the real world. The written down value on the schedule is $30,000. So if they write them off, the tax saving for the company is $7,800.
So the next section is motor vehicle fringe benefits. So go to the next slide. I might just take a moment to just explain fringe benefits tax because it is one of the more confusing taxes. So I'm sorry for people who are already fully aware of what this one is, but I'll just take a second. So FBT is designed to tax benefits that are provided to employees that aren't cash. So the ATO obviously taxes wages, taxes distributions, taxes dividends, but prior to the introduction of FBT, wasn't able to tax employees on the other benefits they received. And obviously those other benefits can be quite significant if we're talking about things like cars, insurances are being paid for by the employee. So it's designed as a catch-all to make sure that the employer can't get around the tax system by providing a benefit in another way. So the most common fringe benefit that we see is motor vehicles, as you'd expect. A lot of employers provide employees with motor vehicles. So we've got a few tips here for ways to reduce either the FBT payable or the employee contribution required for motor vehicle fringe benefits. So first of all, there's two ways that we can calculate the benefit provided when we're providing a motor vehicle. The ATO provides us two methods. The first method is called the statutory method, and that method basically looks at the value of the vehicle and applies a statutory percentage of that value and says that's the benefit the employee got. It's meant to be a rough estimation, and the idea is it's easy to apply. No complex calculation required, no logbook required. You just get to have that. The other method is the operating cost method, which is more detailed, more accurate. The idea is that you look at the cost, the total cost of the vehicle to the employer, so the depreciation of the car, the interest on the loan, the fuel, the running costs, repairs and maintenance, everything. Total costs multiplied by the private use proportion. So if it's 50% private, you look at the total cost. Half of that being the private portion is the benefit to the employee. Obviously far more accurate. You can't use that unless you keep a logbook. So first step is I would be asking any employee that has a car, I would be asking them to keep a logbook. I need to keep it for 12 weeks, and then that's valid for 5 years, so as long as the behaviours don't change and the role doesn't change. So for 12 weeks, they just need to write down each trip they have in that vehicle, the starting destination and the starting point, number of kilometres in the trip, and whether it's private or business. At the end of that 12 weeks, we then work out what the private use portion is, and that's the portion we apply for the next 5 years to any fringe benefits and so on. Doing that can greatly reduce the contribution or the FBT payable by the employer. The next point here is to consider commercial vehicles. So utes and commercial vans are generally exempt, depending on the type of ute, so you've got to check that, but most utes are generally exempt from FBT, so long as there's only incidental private use. Incidental private use means driving it maybe to and from work. You might, maybe you'll stop at the shops on the way home from work, but that's pretty much it. It's not your weekend car. You're not using it for anything other than going to work, using it at work, and going home from work. For most people that have a ute, that's probably what they're doing. So if you've got an employee who's doing that, it actually makes sense to give them a commercial vehicle rather than a passenger vehicle. So you don't have to worry about FBT at all in that case.
Yeah, it's important to point out that for travelling to and from work in a passenger vehicle, that is actually, in most cases, not considered business use.
That's right. There's one more point on that slide I was going to make. So when we calculate the benefit being provided by of a motor vehicle being provided to employees, oftentimes for our clients, we don't like to pay fringe benefits tax because that's pretty much the most expensive way of dealing with that fringe benefit in most cases. What we generally do is we calculate what the benefit the employer has provided the employee is. So if we work out that there's $5,000 worth of benefit being provided to the employee, we can make that nil by taking up a contribution from the employee towards that car. So a journal entry that says the employee gave the employer $5,000 for the car, so there's no net benefit. And because obviously the employee's not actually giving them $5,000, we need to pay an extra wage of $5,000 or a trust distribution or a loan to take that up. When we are doing that via a bonus or a wage, really important that we make sure that pay run actually gets processed in the correct period. Because if we're taking up income from the employee in this financial year and we don't get around to paying the bonus till the next financial year, the income is assessable income and we don't get that deduction, so we end up paying more tax than we have to. So an example here, employee of ABC Proprietary Limited drives a car. It's owned by the company and it's got a base value of $55,000. The company spent $12,300 on operating costs, once you include all the interest, depreciation, everything else. So without a logbook, we use the stat method and the amount payable is $10,754. If the employee kept a logbook and they happen to have 75% business use, we could use the operating cost method, work it out accurately, and they'd only be payable of $3,000, so we'd save $7,700. So we've got some specific measures here around companies and trusts, which we'll go through now. I've got a few questions coming in. I will make sure we go back to them in the question section. We'll go back through and answer them all, but just feel free to keep popping them in. So the loss carryback. So this is a measure you probably remember from the COVID budget that the government announced. The idea being that if you've got losses this year, you can take those losses and apply them to a profit that existed in the previous year and potentially get a refund of income tax. It might be easier to show this in an example, Gareth. Yeah. So Company made a profit in 2018-19 of $300,000, and back then it paid company tax of $82,500 on that profit. This year, company's struck by COVID and it's got a loss of $100,000. It can claim a loss carryback. So you can take that $100,000 and say, I want to apply that against the profit I had in 2018-19. I would have paid $26,000 less tax. Tax rate's 26%. Therefore, the company then gets a refund of $26,000 in the 2021 year for that loss. Important to note, that does reduce the balance of what's called the franking account by $26,000. So if, for example, in 2020, ABC paid a dividend of $300,000 to its directors, and that dividend would have had a franking credit of $82,500 attached to it, we couldn't claim this loss carryback because we've already used all that tax, all those tax as credits for other tax. So we can't get it twice. So look, we will work this all out for you, just explaining how it works. I guess the important thing to know is it's there, and if it's available for you, we'll obviously apply that.
Yeah, so the next one up is Division 7A loans. So basically this is where a company issues a loan to directors or shareholders or associates. And so to prevent someone essentially getting a free loan, the ATO says that it must be repaid over 7 years with interest. Now that can be either with physical repayments or it can be offset with dividends.
So I guess this one's more of an FYI than an action point. Whenever, like Gareth said, whenever an individual or a company takes a loan from individual or a trust takes a loan from a company, it does create a situation where money's left the company environment and only company tax has been paid on it. The ATO obviously doesn't like that. If you don't set up a Division 7A loan, any loans you've taken from a company will be considered an unfranked dividend to you, and you can end up with huge tax problems from that. So we'll always set up a Division 7A loan for you, and we'll calculate the minimum dividends you're required to pay off that loan. I guess just to keep in mind that when you're using a company and only paying company tax, if we're not ever declared, when we don't declare the income in an individual's name, we are just deferring that tax because ultimately will be paid for dividends. So I've got an example here. One of the shareholders of ABC Price Limited took $50,000 as drawings throughout the year. They had the expectation there'd be profit and they'd get a dividend to clear it out. But then, as we said, the company made a loss in 21 financial year, and we would look at that and say, well, why would we want to pay out a dividend and create taxable income when there isn't any? So it's not tax effective to pay the shareholder a dividend this year. So we just leave that amount sitting on the balance sheet as a loan. So it's a loan to that director of $50,000. But we need to make sure that we know that's a Division 7A loan. We set up a repayment schedule, and that amount is repaid by dividends declared over the next 7 years between 2022 and 2028. So final section is specific considerations for trusts. So discretionary trusts, as the name implies, have the discretion generally to distribute to, depending on what the trustee says, sometimes it's anybody, sometimes it's anyone in the family or anyone connected to an individual. But there's no set distribution in a discretionary trust. It has to be determined. So the trustee or the trustees have to meet and resolve how they're going to distribute the income for the year, and they have to do that before 30 June each year for it to be valid. So beneficiaries would include family members, employees, can include companies, can include minors. So there's a whole lot of options. So it's important to consider, and you want to obviously take up as much of as many tax-free thresholds as you can from different individuals and take up all the lower tax rates as you can. So we want to spread that income out if we're able to. So give you an example of why it's important to go through this exercise and have that trustee resolution done before 30 June. Got the Smith Family Trust, makes a profit of $460,416 neatly during the 2021 financial year. So without a trustee resolution, it's going to just be hit with the rate of 45%, and it's going to pay $207,000 in tax. Because the trustee made a resolution before 30 June to distribute income to Mr. Smith, Mrs. Smith, their daughter, their son, and a local charity, the overall tax the family will pay is only $141,000, which is a difference of $65,000. So Obviously that's just a made up scenario, and the numbers depend on what applies to your family. The point really of this example is to show that even if we did all that, even if we do all the best tax planning, we distribute it the best possible way, if we don't have a trustee resolution and we get an audit by the ATO and we've got this kind of income, we can see that the ATO can come back in and say, no, none of that's valid. There's no resolution to determine it that way. We're going to tax the trustee and we're going to hit you with an extra $65,000 payable, please. So really important to get that trustee resolution done. So on that point, just stuck this in here. The most important message we can give you is to make sure you've done your tax planning before June 30. So for all our clients, we're going through a process now of projecting out their income, and then we'll book meetings in and go through what opportunities there are in terms of before 30 June, as well as what does the distribution of income look like, and make sure we get that trustee resolution signed. But that's a very important process, and just really encourage you to make sure you've done that by 30 June. Okay, I think that's all we had to go through. So we've got a few questions in there. I'll just have a look. So we've got one from Susie. Division 7A loan, what is the current interest rate applicable? First up, I didn't know that, but I got Gareth to quickly Google that while we're talking. So the current interest rate for Division 7A is 5.37%. So that's the interest that you have to pay on those loans. Important to note, if you've got a company and a trust that have a Div 7A loan, you're often paying the tax on the interest in one entity and claiming a deduction in the other. So we always try and net that off wherever it's possible. But whereas with an individual, you are just paying that interest. So it's true, you're paying extra tax on that interest. One from Jeff. At what point can you call stock obsolete?
Yeah, probably the best way to determine that is if you go back to that other slide we had before. There was 3 methods, one of which was the net realizable value, which basically means what can you sell it for. So if the stock essentially can't be sold or can't be sold for any reasonable value, then that's when you could call it obsolete.
Yeah, so
you're essentially valuing it at $0.
Yeah, there's no fixed time frame. If it's been there for more than 12 months, I'd be really questioning how it could have a net realizable value. Maybe you bought just a lot too much and you're still getting through it. But if it's literally been sitting there for more than 12 months, I'd be questioning how it can have any value. But it doesn't need to have been there any set amount of time. Theoretically, you could buy something today and it becomes obsolete because it's replaced tomorrow. So there's no set time limit. But that's why I mentioned it's good to have records of why you made the decision, especially if it's not obvious. If it's newer stock, but you need to write it down. Then maybe have just an email or a note on the stock take sheet saying why you're writing it down.
Yeah, it could even be stock that has come in that turns out to be faulty, or if it can't be sold, its value is 0.
Yep, no, that's right. And is purchase of a business or purchase of share in a business, example buying out a partner, allowable for instant asset write-off? And does this depend on intangible versus tangible assets purchased? So, yes, it does depend on intangible versus tangible assets purchased. So if you're buying a business, and that generally you buy a business, it's going to include some stock, it'll include some plant equipment, and it'll include goodwill. You can, when you buy that business, you're not going to get a deduction for the business purchase as such, but you are then going to be able to get a deduction for the plant equipment you purchased as part of that business, and you'll be able to, assuming you qualify for all the other eligibility criteria, you'll then get a temporary, you get the temporary full expensing of those plant equipment and get a full deduction for it. The rest of the business purchase, the goodwill and the stock, is just subject to normal rules. So no deduction for the stock. For the goodwill, it becomes a capital asset, and the stock just becomes trading stock in your business. Yeah, I think that might be it, unless there's no other questions. No, I really think we got them all through. Okay, thanks everybody. So yeah, overall message if I can leave you with is get in touch if you haven't already, and make sure you speak to someone before 30 June so we're not missing out on actions that could help you. Thanks.
Thank you very much.